Hello, I'm David Mandy. I'm president of O&M Partners. I want to welcome everyone today to the Seabridge Gold Town Hall webinar. Seabridge trades under the symbols SA on the New York Stock Exchange, They also have a listing on the TSX under the symbol SEA. For those of you new to these broadcasts, about 6 years ago, O&M recognized the sea change in non-deal investing markets. Suddenly, there were a whole new generation of self-directed investors that couldn't necessarily be found in all the financial centers. So the investors are now receiving information at home that used to be geared pretty much to the professional investors in office towers. The questions and the Q&A are for everyone. This broadcast will answer questions you didn't know to ask. Questions will be easily answered by going to the question portal of GoToWebinar. You can also email us. For any questions that remain unanswered, we'll be sure to follow up in a timely manner. It's a real pleasure today to introduce our introductory speaker, Jim Anthony. Jim has co-founded Seabridge Gold and has helped finance and advise a number of junior gold producers and exploration companies over the past 30 years. Mr. Anthony writes gold market commentary for Seabridge Gold's financial reports and is regularly consulted on the gold market by institutional investors in North America as well as in Europe. Originally a student of economics, Jim has become a discipline of markets. The tape can tell you much more than any economic model. Quote, Jim. And on that note, it's a pleasure to turn the call over to Jim.
David, thank you. So just first of all, to look at the short term of what's happening in the gold market, which isn't making any of us really happy at the moment. We've been in a correction for the last couple of months, and the question is logically why? And as it turns out, there's a rather simple answer. This quarter, the Treasury is going to issue $900 billion less in Treasury securities than was originally predicted 2 months ago. And of course, that means the Fed has not had to increase its current rate of monetization of debt, purchases of treasuries, by anywhere near as much as was expected. And why is that? Because of Nancy Pelosi. It seems that she and Mr. Trump were not able to agree on a second stimulus package in the fourth quarter, and so all of that has been deferred. But do not despair. President Biden will, I am very confident, be able to catch up and then some, and we will begin to see quite soon the level of Treasury deficit and the further monetization of debt by the Fed that we expected 2 months ago. And this little correction in gold will have come to an end, we think, within a month. So now looking at the bigger picture, Rudy, if I can ask you to move. Yeah, there we go. There are a number of really good economists out there, but the one who's had the most success in calling the big turns in the global economy over the last 30 years is a man named Louis Gave of Gavekal. And he's made some declarations this year, which are unusual for him. He was a deflationist. He's now an inflationist. And he is identifying what he calls the great reversal. The three great prices that turn the global economy are the US 10-year yield, oil price, and US dollar. 1 year ago, the 10-year yield and the oil price were falling while the US dollar was rising. Today, it's the reverse. The yield and the oil price are rising while the dollar is falling. The world has changed. As he sees it, when I see a market where interest rates are rising and the currency is falling, alarm bells go off. Later in this interview, he actually compares the US economy to Indonesia. Not a very pleasant thought. His overall view, if we put it in a nutshell, is that the 4 trillion plus in additional debt that he expects to be issued this year is going to be funding consumption. It will be unproductive, no major investments for that money. He is expecting that the Fed will keep interest rates low. They will cap them, probably in the area of 2%, 1.5% to 2%. And when they do, the US dollar will take a 20% hit, and near-term inflation, and meanwhile, will rise to around 2%. So as he puts it, come this spring, if the Fed caps interest rates, gold will thrive. We agree. Next slide. Western economies, in our view, are returning to stagflation. The lovely time of the 70s, some of us were around for that time. It wasn't easy. In our view, we've entered a new inflationary era, but at the same time, the labor market is very weak and requiring enormous stimulus. So we're not getting the benefit of inflation with growth. We're getting the benefit of inflation with more stimulus. Huge deficits are going to be needed, and we have to do it. We have to fund them without raising rates. That's the trick, as we'll get into in just a sec. Massive stimulus is going into the mainstream economy, not the Kiwi of the past. This is not 2009 to 2014. It's going into consumption. It's going into the mainstream economy. It's not funding assets. The supply chains, meanwhile, have been disrupted, thanks in part to President Trump's trade wars. And these disruptions are causing shortages and inflation as well. Meanwhile, we're getting the vaccines finally, and we're going to see a boost in growth short term. We don't think it'll last, but money is going to come out of savings and into consumption, spent by those consumers who are still employed and feeling more like they're able to enjoy life again. Meanwhile, the Chinese currency is strengthening. It has been in an upward trend now for several months. The Bank of China has indicated it is not going to do the same kinds of things it did in 2008, 2009. So its currency is rising. It's also the net importer of capital now worldwide, having replaced the United States. So that makes Chinese imports more expensive. And on the other side of that equation, US companies are restocking their low inventories with a falling dollar. And at the same time as that, money supply is rising at an unprecedented rate. So you can see some of the charts here. The first one, upper left, is US personal consumption expenditure index, which is the Fed's favorite measure of inflation. It has begun to take off, and that's hard for it to do because the calculation is designed to prevent inflation from showing, but here it is. And interesting to note that it is food that is driving it right now at about 3.9% this past month. But we're shortly going to see energy and rents play into that number and continue the upward trend. And then you look to the right, inflation expectations, measured by way of the 10-year break-even, higher than they have been in the last 10 years. And you might think it's just the United States, but bottom left, you see that the 10-year break-even in Germany is also on the rise, not quite as aggressively, but when you consider that Germany was going to be the center of worldwide deflation, it's obviously not the case anymore. And all of that underpinned, bottom right, with an absolutely stunning rise in the number of US dollars in circulation. In fact, 40% of today's dollars in circulation are less than 1 year old. Slide, please. Now, all of this is happening while the labor market is weak, and the labor market still remains the key to an improvement in the economy. Initial jobless claims are still running at 4 times pre-COVID levels. The ISM and PMI data, both of these indices carry a sub-index on jobs, and for both of them, that number is negative, for the past several months. The December jobs report was a disaster at 140,000 jobs lost, and half the jobs lost due to COVID are still not back, as you can see from the chart on the right. Next slide, please. So what we have is a continuing need for huge deficits and fiscal stimulus spending. Nearly 20 million adults are currently behind in rent or mortgage payments. In the third quarter of 2020, nearly 25% of household income came from government transfer payments. Because we didn't get the next stimulus wave, that number has retreated, but we expect to see it going back to those kinds of levels as the Biden administration gains traction. 50% of Americans don't have $400 to meet an emergency and are not sure where they could get it. In 2021, Congress is expected to approve about 2.6 trillion in additional stimulus on top of the usual budgeted deficits, which were running about $1 trillion pre-COVID. So the Fed must fund this stimulus because it's just not possible to pull that kind of money out of the economy unless you offer much higher interest rates. The fiscal 2020 deficit was 3.1 trillion, and I should note that federal expenditures are actually double tax revenue. So we can expect at least another 3 trillion deficit for this year, this current fiscal year, or about 30 trillion in overall debt by year end. In 2020, the Fed's addition to its balance sheet was almost exactly equal to the increase in the deficit. So in other words, this is monetization. The Fed will have to fund at least 3 trillion in quantitative easing this year to fund the deficit, and its current pace is just 1.44 trillion. And one of the reasons for forcing the Fed into this position is that foreign ownership of treasuries is at a 10-year low. So when you look at this level of monetization, that is the death of any currency. Next slide, please. So it's easy to see how Louis Gave gets to his 20% further drop in the dollar. This is the Fed's dilemma. The Treasury is going to flood the market with new net issuance, and who can doubt that President Biden will only increase that probability, putting upward pressure on interest rates. And further, as we see growth data boost in the current quarter, which we will as the vaccinations take hold, we're going to see a further pressure on interest rates to rise. Now, you might think, what can that really mean in the long term? Well, it means a lot in the short term. A 50 basis point increase in the interest rate payable on the US debt, the 27 trillion, equals the cost annually of the US Navy. Rather small increases lead to rather large results and the potential for a downward spiral in deficit spending to not only meet these requirements of stimulus, but also to meet the increasing requirements of interest payments. The economy can't afford higher rates either, not just the Treasury, but also the economy. 20% of US public companies are zombies with operating income less than interest expense. So, as Louis Gave argues, and we certainly agree, the Fed is likely to implement yield control in 2021. Now, the chart shows you the impact that is likely to have on gold. The red line is gold rising until it doesn't. And it doesn't as real rates begin to climb. They're negative, the real rates are negative, but as they begin to rise, gold begins to subside in price. That relationship has been solid gold for a number of years now. It's very unlikely to change. With yield control, the blue line is going back down and the red line is going back up. It's pretty much that easy. Next slide, please. So we expect gold-friendly Fed policy in this quarter, which will bring the current correction in gold to an end. We're going to see increased quantitative easing to fund fiscal stimulus, which will further weaken the US dollar. We're going to see yield control which will lower real yields. And these low yields, negative yields, will drive investors from bonds to gold. And it won't take much to do that. Global bonds, tradable bonds, are currently in excess of US 100 trillion. And if you look on the left, the chart tells you that 80% of the debt that is in local currencies is now yielding below 1%. So in other words, yielding less than nothing. And now just recently, US corporate bond yields have gone in the same direction and are now yielding negative. That is not an incentive for bondholders to stay put. We think they will begin migrating toward gold. So what is our estimation of where gold is headed this year? We think once we get through the current hiatus in stimulus spending, we will see gold go to $2,500 plus this year. And that impact will be even more pronounced on gold stocks. So next slide, please. The gold bull market has just begun. Gold's share of global money supply is 0.5%. It's growing at a rate of 1.3% a year versus 28% for US dollars, 19% for global currency, all told. Gold's share of global assets is less than 3%. And for gold stocks, it's worth noting that Apple's market cap is about 2.5 times the entire gold industry. So there's lots of room to run here, and there's lots of money to make it happen. Thank you, David, and back to you.
Thank you, Jim. It's Jim Anthony, who's the co-founder of Seabridge Gold. We always appreciate Jim's gold commentary on the gold market, and you can see why he's regularly consulted on his viewpoints by institutional investors. Now, a pleasure to turn the call over to Rudy Frank. Rudy's the chairman and chief executive officer and co-founder of Seabridge Gold. Rudy's been in the business for over 35 years. He trained as a mining engineer at Columbia University and has very broad experience in the industry. He's been involved in every stage of development. He started Seabridge in 1999, over 20 years ago. It's a long commitment. Rudy has always played the long game. He successfully created the best leverage play to rising gold prices. Seabridge has more gold per common share than any company in the industry. They also have more copper than most copper companies. Seabridge really checks all the boxes for an investor. They have blue chip shareholders, great liquidity on the New York Stock Exchange, plenty of cash in the bank. All their core assets are in Canada. They're very tight capital structure. They've done most of the regulatory de-risking, and as I said, this management team is one of the best in the business. So on that note, it's an absolute pleasure to turn the call over to Rudy.
Thanks, David. Thanks, Jim, and thanks everybody for tuning in here today. So I'm going to run through the presentation fairly quickly today because I really enjoy the Q&A sessions more than me just droning on about the company. But what I'd like to cover in terms of today's presentation is really more talking about what we have in store for this year at our projects. Before I get to that, though, I'm always asked, why do you have 90% of your family's net worth in Seabridge common shares? Well, I think that's pretty easy to answer from my perspective. First, like Jim, we believe the price of gold is going to go substantially higher. If it is, our shares will outperform gold and other gold equities and just about every other investment you can make. We also have the world's largest undeveloped gold and copper projects situated in a safe jurisdiction. In December, as I'll highlight today, we also bought a fifth deposit that is now being implemented into KSM, which will not only make the KSM project bigger, but more importantly, better. And then last but not least is our team has found more gold over the years than any other exploration team on the planet, and I include all the majors in that. And we now have 3 earlier stage exploration projects, which we're now really starting to sink our teeth into, any one of which we believe can be a company maker. Well, looking at our history there, when Jim and I started the company, the idea was build a company that provides more gold ownership per common share than anyone else out there, and that should lead to outsized returns. Everything we do from exploration to acquisition is geared to growing ounces per share. And as you can see here, we've delivered on that concept over a 21-year history. And in fact, this slide here does not include the 50 billion pounds of copper resources we have, or the 700 million ounces of silver resources we have. I did an interesting calculation here earlier today. If you look at all the metal that we have in the ground at our projects and take today's metal prices for them for the gold, copper, and silver, each one of our shares now is backed by almost $6,000 per share of metal value in the ground. Now, obviously, that doesn't take into account recoveries or timing to production, but the bottom line is that our shares are well covered by actual physical metal in the ground. In fact, if you look at our ratios compared to the industry, whether you're looking at reserves or resources per common share, as David highlighted, nobody comes close to us. We provide 5 to 50 times more gold ownership per common share than anyone else out there. And what this has translated into is what Jim and I designed and hoped for when we formed the company more than 21 years ago. And that's significant outperformance in our share price relative to gold and other gold equities. And as you can see on this chart, we've delivered that over the long game, but also during those periods of time when gold is in a strong upward trend, like from 2004 to 2007, and then again coming out of the financial crisis in 2008 to 2011, and then coming again out of the bottom in the gold market in 2015 when gold hit $1,050 an ounce. If you want exposure to higher gold prices, you're a gold bug like I am, owning Seabridge shares makes a lot of sense. So our most important asset is KSM, an asset we acquired in the year 2000 from Placer Dome. Many of you know this asset. I've talked about it a lot. We've now invested over $400 million into KSM, defining today the world's largest undeveloped gold copper project as measured by reserves and resources. We've not only defined a large resource base and reserve base, but we've also taken this project successfully through the environmental assessment process and have the support of the local communities and indigenous populations in and around the project. To our benefit, a lot of money has gone into this area here that we didn't have to pay for, improving the roads, bringing cheap hydropower to the area, and also port facilities. If you look at a lot of these big undeveloped projects around the world today, they're going to have to build power plants, they're going to have to build roads, and they're probably going to have to build ports. We now have all three of those available to us that was spent by other people's money. And the most important aspect for our success going forward here will be the cheap power. We've now secured with BC Hydro 250 megawatts of power under contract from this line, which provides to the project cheap green power, but also power that we'll be able to buy for about 5 cents per kilowatt hour. We finished a pre-feasibility study in 2016 that defined a robust project, looking at the 4 deposits we had at the time. And just in December, we added a 5th deposit that's shown here outside of the project area called Snowfield, a project that was owned by Pretium Resources. Prior to Snowfield, our 4 deposits gave us 7.6 billion tons of resources in all categories. When we went through the environmental assessment process, we only have 2.4 billion tons of tailings capacity permitted. So we've been focusing on what is the best 2.4 billion tons that we can mine to drive the best economics. If you look at the 2016 pre-feasibility study, which was just verified again in 2020 with independent consultants going through looking at all of our estimates, it shows a project that can produce metal for more than 50 years, and at today's metal prices generate a after-tax cash flow of 27 billion and an after-tax net present value at a 5% discount rate of about $7 billion. That mine plan does not yet include the 2 new zones we added in exploration, the Deep Kerr Zone and the Iron Cap Zone. We did an updated study in 2020 that showed even a further improvement on the project's economics by capturing some of this higher grade copper into the mine plan and taking out some lower grade material that's in the reserve mine plan. Things got a lot better though with our ability to buy Snowfield in December. This is an asset that we tried to buy when it was still owned by Silver Standard in the year 2008. We actually went in with a cash bid in our back pocket. We had a bought deal proposal in place from JP Morgan, and unfortunately at the time, Silver Standard did not accept our offer price. 2 years later, they sold this asset along with Bruce Jack to Pretium for about $500 million in cash. We continued dialogue with Pretium after they acquired it, and did studies on it to show that Snowfield would have a positive impact on the project's economics. It wasn't until a change in management at Pretium over the last year or so that provided the ability for us to get a deal done on terms that made sense to us, as well as terms that made sense to Pretium. As many of you know, Pretium is now operating a high-grade cash flow generating property right next to us, the Bruce Jack project. To build that mine, they took on a lot of debt. The new management team is focused on not only delivering cash flow from the project, but more importantly, also at the same time paying down its debt. We purchased Snowfield for $100 million in cash, US, and a 1.5% royalty. And then when we closed on this acquisition, Pretium used $100 million in cash immediately to pay down its revolving credit facility. Why did we acquire Snowfield? Well, we believe that we'll be able to show a much improved project in terms of economics, but also a lower risk project in terms of mine planning. When we look at the project development before Snowfield, our pre-feasibility and our 2020 PEA incorporated capital-intensive block cave mines into the mine plan. There's not many companies on the planet that actually have the capability to develop large block cave mines efficiently. In fact, in the gold space, there's only one, Newcrest, and the copper space, maybe two. With Snowfield, we believe we'll be able to show a project that you can look at, open pit only, more than 30 years of mine life, filling up our tailings capacity of 2.4 billion tons without having to worry about block cave mining until well into the future, if you ever want to go after that. We are now in the process of doing an updated pre-feasibility study at KSM to incorporate Snowfield. We believe that this will result in an increase in our proven and probable gold reserves, but more importantly, a much improved project from a capital efficiency perspective in terms of paybacks, better net present values, better internal rates of returns, and a simplified project in terms of mine planning, eliminating the need for block cave mining for many, many decades into the future. This season, we plan to go into the field and do some metallurgical test work. Following the metallurgical test work we did about a decade ago with Pretium, we'll do some confirmatory drilling in terms of geotechnical drilling to confirm pit slopes, and then expect to have an updated pre-feasibility study done on KSM within the next 12 to 15 months. But we believe that that will show a much improved project. Moving on quickly to the other projects and our plans for this year. Courageous Lake is a second large asset we have in the portfolio located in the Northwest Territories. As we look at our portfolio today, I think we've determined that Courageous Lake could be considered a non-core asset, and the current market environment could generate a lot of value to us, either in the form of a sale or a joint venture. We are now working with a banker to look at unlocking value to our shareholders with Courageous Lake to generate value to our shareholders that we can then deploy back into the assets where we believe we can drive additional value. Those assets are predominantly, in addition to KSM, the 3 exploration projects we now have. We purchased the Iskut property in 2016, buying a public company called Snip Gold. It's situated about 40 kilometers away from KSM. A lot of similarities to KSM. When we bought KSM, the known resources were about 3 million ounces of gold and 2 billion pounds of copper. When we bought Iskut, the known resources were about 2 million ounces of gold and about 500 million pounds of copper. There's a lot of similarities to Iskut and KSM in terms of structural controls on the mineralization, alteration patterns, and clear evidence of big porphyry systems. We are now focusing on an opportunity that's situated underneath the Johnny Mountain lithocap. We actually did a drilling program in 2020, finding gold and copper over meaningful widths. Our interpretation of the drill results so far is that we're still above the system, the main part of the system, and we will go back with further testing at Iskut this year. Second exploration project is in Nevada, a large land package we purchased from John Paulson. We acquired a large land block called Snowstorm. We also added to that in another land package called Goldstorm. These two projects sit on the intersection of the Getchell Trend, the Nevada Rift Trend, and the Carlin Trend. We did our first drill program here in 2019, confirming we had the right rocks, the right structural elements, and the right alteration that led to the big deposits at Twin Creeks and Turquoise Ridge. Our target at Snowstorm right now is the Twin Creeks, Turquoise Ridge style. We are still drilling from last year's program. Last year's program got delayed a bit because of COVID. We're now back with 2 drills at the site and expect to have the 2020 program completed by the end of the first quarter, and then plan to have a follow-up program later this year. The best place to look for gold deposits are inside of existing mines. And as you can see here, these 2 big mines to the south of us, Turquoise Ridge and Twin Creeks, lead us to high expectations in terms of what we think we can find. The most recent acquisition on the exploration side was the 3 Aces project in the Yukon, our first entry into the Yukon. We've been following this project for many, many years. In fact, our head of exploration, we gave him the ability to work as a technical advisor to the previous owner here, because we wanted to follow the exploration results here. To call this a project really does it injustice. This really is a district, over 300 square kilometers, with 30 kilometers of strike length, with gold showings up and down the entire belt. In fact, if you look at some of the historic drilling that's been done here by Golden Predator, you're looking at multiple meter intercepts right at surface at grades that are, 1/3 of an ounce to multi-ounce per ton right at the surface. At one point in time, Predator Gold did a bulk sample here. They mined about 8,000 tons of material, and they actually produced about 10,000 ounces of gold from a simple gravity circuit. There's no question that the gold is here. It's evident in the drilling and the bulk sample that was done. What hasn't been tested here yet is the down dip extension of these veins, as well as parallel vein structures that we believe exist there. This year, we plan to do some geophysical work to better identify the structural elements that lead to the mineralization here, and then to follow it up with our first drill program at 3 Aces later this year. So again, coming back, what is the investment concept in Seabridge? If gold's going up, so is our share price. KSM, there's not many opportunities out there that the big companies can go after. Our goal at KSM is to attract one of the majors on either the gold side or the copper side, or perhaps a syndicate that would spend the dollars to develop KSM, with us maintaining a meaningful interest in the project. The last year has been tough because of COVID in terms of getting a deal done. I believe, though, that the universe has changed here quite a bit. If you look at metal prices, clearly the price of gold and copper is as high as it's ever been in the last 5 years plus. The amount of cash flow the big companies are now generating from these higher metal prices. And then last but not least, the need of the big companies to start focusing on the future. The elephant in the room that's finally being recognized is the lack of reserves that big mining companies have. Within 10 years, the gold industry will run out of reserves unless they replace them. They're not replacing them through their own exploration. They're going to once again have to turn to M&A to build production beyond the 10 years of reserve they have left. And we believe we have the best project in the world available, willing to joint venture on the right terms with the right partner. Spoke about the exploration portfolio, any one of which we believe can be a company maker. And then last but not least is being able to show what Snowfield can do for the greater KSM. There's no doubt in our mind and work we've already done that we'll be able to show a much improved project that's de-risked from the mining sequencing perspective, but also much better economics and easier to develop. As David mentioned, we are dual listed, trading on both the New York Stock Exchange and the Toronto Stock Exchange. Most of our volume is in New York. We have a market cap today in the US of about 1.4 billion and about 1.8 billion in Canada. Still relatively low when you look at our valuation per ounce in the ground or valuation per metal in the ground. So David, that's it for my presentation. Happy now to open it up to questions.
Thanks, Rudy. Great presentation. I did misspeak. I said your assets were all in Canada. Obviously, they're all in, I should have said North America, which is the place to be for sure. Excuse that. Well, let's start with Chip Richardson. Chip, do you have a question today for Rudy? Just waiting for the unmute. Okay, we'll go. Yeah, he'll come back. Chip, when you've got, or you can text in a question, okay? We have Trey Rake on the line. Trey, do you have a question for Rudy today? Excuse me, I'm sorry, Trey. Chip, you're unmuted now, correct?
Yeah, I thought I was unmuted already.
Okay, we can hear you now, Chip. Do you have a question for Rudy today?
Yeah, well, thank you very much for the presentation, Rudy. I always enjoy them, and I'm always impressed with your reserves of minerals. Are you really receiving any kind of interest, any kind of negotiations with your target purchasers, joint venture partners, or?
Well, yes, we are. I mean, there's no denying that when COVID hit last year, the world shut down. Companies that we were engaged with, that we were moving towards a joint venture structure that I think either side could have said yes to, stopped. That's changing now. Obviously, getting COVID behind us in some shape or form with vaccinations will be helpful. But dialogue is continuing, even though M&A hasn't happened here much recently. And I believe that as this year unfolds, we'll be able to get that deal done on the terms that make sense. And the other positive is, I mean, Snowfield will have a big positive impact from companies that have looked at KSM in the past, that the block caving may have, stopped them from transacting with us, but being able to show mine plans now that mine exclusively open pits for 30 plus years, we believe will have a big positive impact in our discussions, because we now will have a more competitive tension with more bodies at the table being able to transact.
Thank you very much. Your progress is always very impressive, and I appreciate the presentation.
Thank you, Chip.
Thank you, Chip. We'll try Trey Wright. Trey, question for Rudy today.
And don't forget, David, Jim is still on the line, so questions for Jim would also be great.
Terrific, great point. Okay, Trey's not answering. Let us go to Howie Flinker. Howie, question today?
Hi, Rudy.
Hey, Howie.
Rudy and I spoke last week, so I don't have any questions.
Okay, great. Thanks for being on the call. Let's turn to Marshall Barrell. Marshall?
Yes, thank you. Hi, Rudy. Thanks very much for the update. It's always helpful. I do have a few questions. You mentioned that $6,000 worth of metal in the ground. Is that Canadian or U.S. dollars?
That's U.S. dollars. I used to call U.S. dollars the real dollars, but maybe as we go forward, they may not be anymore.
Yeah, well, I'm not sure either will be, but that's a whole other topic.
And I remember when we first moved to Toronto with the family, it was minus 30 degrees. And I remember Jennifer asking me, is that Fahrenheit or centigrade? I said, I don't think it matters. So $6,000, whether it's US or Canadian dollars, it probably doesn't matter.
That's true. Have your aspirations for a deal in the form of the terms you'd like, what type of arrangement you'd like, has that changed any over the last number of months?
No, it really hasn't. I mean, our goal remains to hang on to a meaningful interest in the project while minimizing our capital contribution. I will tell you, though, that our ability to go out and do $100 million bought deal financing within an hour in December, opened up our eyes in terms of financing that might be available to us if we want to try and keep a bigger piece of the project. So our goal remains the same: keep a meaningful piece in the project while minimizing our capital contribution. But the ability to perhaps provide a bit more capital for a larger stake in the project, I would not take off the table. It's a function of negotiation.
And then I'm wondering, as I watch this, and I've followed the company a long time, been a shareholder a long time. A few years ago they talked about the big banks being too big to fail. I'm wondering if KSM has gotten to be too big to succeed, that it's just too much of a project in two major metals, that the potential partners just aren't interested in taking it on.
I think there probably was a time when that was the case, Marshall, but I think if you look at the consolidation we've seen in the gold space, Newmont combining with Goldcorp recently, Barrick combining with Randgold. As a result of those mergers, they have a bigger footprint now, and they have more ounces to replace every year as they mine them. On the copper side, it's never been an issue. In fact, the copper companies come in and look at KSM and say, you've got now 9.8 billion tons of total resources. It's taken you, 40 years to mine 2.4 billion tons. How do we make the project bigger than 170,000 tons per day? And my belief is that over time, KSM it'll get capitalized at that 170,000 ton per day initial throughput, but over time, the throughput will increase. And what we've done in terms of our designs is to make sure that we haven't built embedded bottlenecks that wouldn't allow an increase in throughput. So I don't think it's too big. In fact, I think it's exactly what the majors need. Majors need capital efficient project. Show me a project today that can generate the type of cash flow or low total cost that KSM can. They want projects that can be permitted in safe jurisdictions. Well, we've already gone through that process and have the first 2.5 years of construction permits already in hand. And they want projects that are capital efficient in terms of payback relative to mine life. I mean, we believe we'll be able to show with the addition of Snowfield a payback period in far less than 10% of the project life. So I think the boxes that KSM can check. And then last but not least, just off the top of my head, it's also the scarcity of new projects. The big companies are not finding gold anymore themselves. They have to go out and do new projects. I remember back in the 1990s when the gold companies, the majors, were actually good at finding gold. In fact, that decade, they were able to find 1.4 ounces of gold for every ounce they mined. So they were replacing reserves each and every year through their own exploration activities. The next decade, from 2000 to 2009, their finding got cut in half. It went from 0.7 of an ounce to every ounce that they mined. And it was also during that decade they started to roll in the acquisitions and doing most of their acquisitions at the top of the market. If you look at the most recent decade, their finding has been less than 25% of what they mine every year. And that's in an environment when the gold price has gone higher. So I think that they have no choice but to do deals. And I think the type of assets they're going to be focusing on are assets like KSM.
Yeah, that's very interesting. And also the fact that you've got such a long life, decades, generations there. That's very, very, very interesting. Thank you very much, Rudy. We'll stay tuned.
Good hearing from you.
Thank you, Marshall. Oh, Bill Lupin's on the line from Till. Bill, do you have any questions today? Okay, let's turn to Doug Loud. Doug?
Hi, Rudy. Thanks for a great presentation, especially for the easily confused lawyer me, the great explanations of each project and how these big companies have to buy new projects or stop eating them. They're eating themselves alive. When you were talking about your silver assets, you said 700, but I didn't hear what it was in.
700 million ounces of silver resources at KSM.
Right. So in other words, your copper and your silver are bigger than most other copper or silver companies all by themselves.
That is correct, Douglas. That is correct.
Oh, no. That answers my question for today. Just keep on doing all these great things. Just love these projects. Thanks.
You're welcome.
Thank you, Doug. Scott, we'll turn to you. You've got questions from our audience.
Yes, I do. The first question is relates to the Mitchell Treaty tunnels. Seabridge was granted license of occupation right away over the tunnel route, which runs through Tudor Gold, Tooten, AMK. The TOO includes a limitation clause that makes it subject to the prior rights for mineral claim holders. Has Seabridge received permission from the mineral claim holders to build the tunnel through their mineral claims?
No, well, they haven't found any reserves yet or anything that they've defined as economic resources. They're on their track to do that. And as we've stated publicly many times, with a tunnel that goes 24 kilometers, it's quite easy to do a bit of a radius in the tunnel and basically go around where they actually may have a feasible deposit. They're onto something there. They are finding long runs of gold with tiny bits of copper in it, but they have not found anything yet that actually would result in us needing to change the tunnel route. If and when they do, we can actually change the tunnel route, change the radius. It's important to note that holding a mineral right doesn't mean you own the ground. The ground is owned by the Crown, and the Crown is able to give rights of way and license of occupations along the ground that they own, and that's what we have right now. We're going to be good neighbors. If we need to move the tunnel route and tweak the radius, we can do that without any real change to the capital cost of the tunnel.
Great, thank you. And I have a question for Jim. Jim, what do you think is the end game for the huge deficits?
Well, that we don't know. The likelihood is that, well, the last time the deficits were this large and the debt was this large as a percentage of GDP, that was the Second World War. And we got out of that debt by making the dollar worth a lot less. That seems to be the path that we're on. The only other path would, of course, be to have a series of ruinous defaults, and that would reduce the obligations of those who owe the debt. The problem with that approach is that debt is somebody else's asset. So you can't just terminate the debt or default on it. It has to be done over time with a reduction in the value of the dollar. And that's where we're headed. And I think, Louis Gave has it right. If we're going to do anything at all about preventing a higher interest rate and the impact that would have on the federal debt and on the economy, then yield control will be necessary, and that will sacrifice the dollar. They have to sacrifice one or the other, either the dollar or the debt. And we think it'll be the dollar.
Thank you, Jim. That was a good answer. Next question is, would you please talk about the recently announced at-the-market offering?
Yeah, so it's nothing new. We actually had one in place for the past 14 months. When we filed our new shelf prospectus in December, which gave us the room to do the $100 million bought deal financing that we did with Cantor Fitzgerald, we had to refresh the ATM, and that's all we do. It is a very simplistic way to finance our needs going forward. You look at an ATM, it's up to the company if and when they want to issue shares. They choose the amount, they choose the pricing. If they don't like the market price, they don't have to do it, and the commission structure is a lot lower. I mean, the fact of the matter is we issue shares every year to fund our programs, and the expectation is the programs we do offset the dilution with accretion to ounces. And if you look at our 21-year track record, we have delivered on that. We're funding programs this year at KSM, at Iskut, Snowstorm, and 3 Aces. If we need to raise additional cash, we now have that tool in the toolbox to use the ATM.
Thank you. The next question is, what is the most likely form of payment should Seabridge enter into an agreement to sell one of their properties? For instance, let's say Freeport McMoran wanted to purchase the KSM project. Might Freeport just give Seabridge shares of Freeport stock in exchange for the property? Is it ever done? In my mind, I could see Freeport giving something like 30 million shares or more of its stock in exchange for KSM.
30 million shares doesn't even get close to the value we see. The fact is, we're not looking to sell KSM. We believe that we drive far more value to our shareholders in a joint venture. If you look at hanging on to 30% interest at KSM, at today's metal prices and the mine plans we put forward, the project generates over $2 billion of cash flow a year for many, many years. 30% of $2 billion is a big number, which would result in a much higher share price than we have today. Now, I'll look at the right price, everything is for sale, but selling an asset out from underneath a public company does not make a lot of sense from a tax efficiency point of view as well, because the gains we would have on the book would become taxable and would be writing a big check to the Canadian government for that. So our goal is not to sell KSM, it's to joint venture it with a company that has the technical, financial, and social wherewithal to develop a mine of that scale.
Excellent. And I guess this is a similar question. Can you explain why Seabridge has never developed any of the projects to begin to generate cash flow?
Rudy, you've got this one before.
Well, when you look at the graveyard of companies that tried to make that transition from exploration to production, it's fraught with peril. I tried that once earlier in my career, and it wasn't a resounding success. If you look at the history of value creation in the gold space, a lot of times peak value is reached at the point of discovery, or when you start to define an ore body and show that it can be economic. That period of trying to convert a company from an exploration company to a producing company requires a complete retooling of your personnel. Explorers are not good mine builders or mine operators. It involves a lot of risk in the marketplace in terms of being able to raise the capital necessary. You find that some of your assumptions on your feasibility study prove to be a bit too optimistic, and things don't go as planned. We'd rather leave some of that upside in the production side, bringing a partner in, and minimize our downside by not being the developers of mines ourselves. We're happy to keep streams. We're happy to keep royalties. We have a stream right now on the Red Mountain project that's being put into production by Ascot, a project we sold many, many years ago, and we kept a stream. We have a net profits in the Grassy Mountain project that just was finished by Paramount in a feasibility study, and they're going through the permitting process. And we have a royalty in the Quartz Mountain project that is now, that was optioned to Alamos. We'd rather keep lower risk in terms of the gold flow back to us than trying to build mines ourselves. As I said, I've seen too many companies fail at that and never get back to peak value that they had before they even started talking about building a mine.
Excellent, thank you. And you brought up something that another person had just asked a question about, and that is, can you talk briefly about your investment in Paramount Gold Nevada? What is your opinion of investing in this company in addition to Seabridge?
It's a company that we actually were involved in an earlier life. The original Paramount was sold to Core Mining, and from that sale, Sleeper was spun back out to Paramount shareholders. In addition to that, they bought a company that we were involved with called Calico that had 100% of the Grassy Mountain project. Grassy Mountain was a project that we owned at Seabridge. We sold it to Calico. We kept it 10% price. We helped that company move through the engineering studies. We own about 8.5% of Paramount as well. We think it's a company that's well managed with a lot of upside. Sleeper and Paramount, between Sleeper and Grassy Mountain, I think they have almost 5 million ounces of gold in the ground, and they only have a little over 30 million shares outstanding.
Thank you.
Some will become an investment.
Couple more questions from the audience. Thank you, audience, for sending in your questions. This one comes in as, do you expect a deal coming on KSM before you complete the PFS?
Possibly. You know, it's a function. I've always said terms trump timing. If we can get a deal with the terms agreed before the PFS is done, we'll do the deal. There's no gun to our head saying that a deal has to happen anytime soon. We'd like it to. Believe me when I tell you that nobody wants to get a deal done more than I do. 21 years of running this company and building the asset base. I want to see a deal happen. I want to see KSM become a mine. But again, terms trump timing, and it's the terms that are far more important to us than just the timing of announcing a transaction.
Thank you. And this question is, with the latest success news, I'm assuming Snowfield, and bringing this story to the new institutional investors, what is their reaction to the latest news?
Pretium's reaction?
No, I think what they're asking is,
Institutional investors, yeah.
Yeah, institutional investors, how have they been reacting to the story since you added Snowfield?
Well, I think it's been fantastic. Just look at the financing we did. We raised $100 million in a bought deal financing, and they exercised the 10% green shoe in a matter of 3 days. The issue described, we were able to buy, so Snowfield has 26 million ounces of gold in the measured and indicated category and 9 million ounces in the inferred, plus 4 billion pounds of copper. We were able to buy that project for $3 per ounce in the ground. So obviously highly accretive to us. And if you looked at the number of shares we issued to do the base to pay the upfront payment, $100 million, and the cost of the financing and the transaction, we issued just over 6 million shares. We got 35 million ounces in return. So we got over 5 ounces of gold per common share, also accretive to us. And then if you look at the structure of the financing, 80 million or so of the financing we did was taken down by existing shareholders. That just shows tremendous support from our shareholders and believing that we're doing the right deals for our shareholders.
Yeah, that's a key fact, Rudy. That tells it all.
Yeah, I still have a few more. Next question is, there was a mention of a limitation due to the tailings capacity. How will this limitation be managed to unlock the full value of KSM?
So it's funny, the First Nations look at us and say, okay, we have a 40 or 50-year mine life now, depending on which mine plan you use, but you're only getting a third or a quarter of your resources. We want to make this a 100-year mine life. And we say, we agree with you, but we need capacity for tailings. And they say, okay, well, let's go permit it. And say, no, not yet. We have plenty of time to do that. The fact of the matter is getting a tailings facility permitted is getting more and more challenging. If you look at some of the roadblocks and some of these other big projects out there, it's all about tailings. The best place for tailings will be pits, old pits that you can fill up with tailings, or old holes in the ground from block caves. So our view is that as we open up KSM and open up open pits or block caves, we'll have plenty of room for future tailings that can come back through our tunnels and fill and allow us to go well beyond the 2.4 billion tons. But there's no necessity to go look at permitting those now, because again, that's decades and decades down the road.
Understood. Another question relating to permits, and that is, does Snowfield need an environmental permit?
No, Snowfield will fit within the what we already have approved for the greater footprint for KSM. What we will need is an amendment to the mining plan to allow us to mine Snowfield. That's not a re-permitting. It doesn't require a new environmental assessment. It requires an amendment to the permits we have in place already, which we will seek at the right time.
And the final question I have from the audience at the moment is actually for Jim. And that is the person saying, I can envision a situation where rates rise and the dollar declines. What happens then to metal prices and other matters? Are there limits to the Fed monetization?
Well, the Fed hopes not, but we're going to test that hypothesis. As rates rise, then the key question is, what are inflation expectations? If inflation expectations are rising faster, and so real yields are falling, then you're going to see gold run very, very heavy to the upside, and you'll see that 20% reduction in the dollar that Louis Gave is calling for this year. So it's really the best circumstance for gold, not unfortunately for the US economy, but for gold, that we would see a falling dollar and rising inflation and interest rates. And that's the world we're headed to. At that point, as I indicated, bondholders don't want to hold bonds, and everybody's looking for a safe place. It used to be in an earlier world that a safe place, if the dollar was falling, was something called the Swiss franc. But now the Swiss National Bank is one of the world's largest hedge funds, and it is not doing anything to protect its currency. In fact, it's doing everything it can to weaken it. The euro is certainly not an option. It's had a nice little run, but fourth quarter economic growth in the Eurozone was negative, as we just got the numbers today, down 0.7%. There's no safe place. Once you begin to take away those places where people look for a risk-off safety, they're gone. It's going to be gold. Maybe there'll be an argument for Bitcoin. That's another matter. There's an argument for silver, and there's not an argument for much more.
Thank you.
Let's try Jerry Needleman. Jerry's been in Seabridge a long time. He's on the call. I always want to call on Jerry. Jerry, nice to have you with us. Jerry, unmuted. Okay, Jerry's not coming on. Any other further questions from you, Scott? Anyone else in the audience have further questions?
I do have a couple more that are just coming in, if we have time for that. This one was, which of your projects are you most aggressively de-risking?
KSM, no question about that in terms of the work we've done. As I said, we put over $400 million into it now, including the acquisition of Snowfield. We're going to further de-risk it this year with an updated study. We continue to collect data year in and year out will be required to complete a bankable feasibility study once the partner is in place. So I think that probably is the one that we continue to de-risk because it's the one that we believe has value to our shareholders in the short to intermediate term.
Thank you. And that does wrap up the questions from, oh, actually there's so many more. Some of these we may just send in to you guys to have answered.
Sure, no problem.
Yeah, I'm getting a lot for like views on Bitcoin, that kind of thing, that I'm sure we would love to have your answer to, but maybe as a follow-up.
Yeah, let's keep it to gold.
Yeah.
I think it's been a great call. Thank you, Jim, and Rudy for presenting today. I'm going to turn it over to you for closing remarks.
We will just thank everybody for their participation today here. As I said, I really enjoy the Q&A portion more than my presentation, although I always enthralled to hear what Jim has to say. Just reinforces on why I have 90% of our family's net worth in Seabridge common shares. Happy to answer any follow-up questions. As many of you know, we're always available. Best way to reach me is by email. My email address is Rudy, R-U-D-I, @SeabridgeGold.com. And when you send me a question or want to reach out to me, send me your phone number as well. I'd rather talk to you than just do an impersonal email response. So thanks, David. Thanks, Scott. Appreciate the opportunity. And we look forward to our next one.
Thanks so much. And thank you, everybody, for your participation today. Greatly appreciated. Have a nice evening. Bye-bye.